You're about to hear my conversation with Prerna Mathews, head of ETFs with Mackenzie Investments. We'll be talking about the 2025 ETF outlook with a particular focus on the level of growth and innovation in the ETF category, why an increasing number of advisors and their clients are drawn to the ETF vehicle, and finally, why ETFs might be best suited for building a resilient portfolio. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, head of portfolio construction in Mackenzie Private Wealth. Today, I'm joined by Prerna Mathews, who is the head of ETFs with Mackenzie Investments. Prerna, welcome to the podcast.
Rajan, thanks for having me today.
Of course. Prerna, we're speaking today as you and the team have released the 2025 ETF Outlook on behalf of Mackenzie Investments and some really fascinating takeaways within the report. I just want to jump right into the material. My first question for you is, it seems every year has been a banner year for ETF growth. 2024 was no different, but as we enter 2025, it looks like we could be in for another spectacular year of growth for ETFs. Do I have that right? And can you help me out by sharing some numbers to put the growth into context?
Absolutely, Rajan. 2024 was yet another record year by a mile and then some. We saw $76 billion of flows go into ETFs in Canada in 2024. Just to put that into context versus a previous record year, it was 45% higher than the previous annual record set in 2021. So advisors, investors certainly spoke with their dollars allocating to ETFs here in Canada. That brings ETF AUM to now $519 billion in Canada. And we've seen this consistent growth, as you say, year over year. Over the past 5 years alone, we've seen 22% growth over that 5-year period in ETFs. And very similarly, over 10 years, it's been 21%. So very consistent. There's certainly a lot more product to choose from for investors here in Canada. So close to 1,500 ETFs now on offer across equity, fixed income, alternatives, active and passive. And that's really helped investors, advisors choose the ETF vehicle, certainly. And just to put into context against total investable assets of mutual funds here in Canada, about 18% of our total investable assets now in Canada are sitting in ETFs. So definitely a very strong year and just continued momentum in ETFs in Canada.
Prerna, that's a great way to kick off our conversation. Now, the $500 billion of AUM, that certainly jumped out to me in the report. Appreciate you calling it out in your initial response. From your perspective, what does it say about ETFs that we've now passed the $500 billion level in Canada?
Yeah, it speaks volumes. It speaks volumes about the increased trust and adoption of ETFs across different types of investors, right? So in the early days, ETFs were really looked at by a small group of advisors, some retail or do-it-yourself investors, and some institutional clients. But we've seen growth, a pickup of usage of ETFs across all investor types here in Canada. And so it definitely has helped newer advisors or newer investors to ETFs become more comfortable as they see the total AUM grow. And as I mentioned, I think choice is a big part of this is growth as well. So when you have more to pick from, when you have more solutions available to you in ETFs, there's more that you can do in terms of constructing portfolios. So that's certainly been part of the contribution to the growth that we've seen here in Canada. Canada's also been quite innovative, right, in the ETF space. We've got lots of examples to show over the years. Active ETFs being a very easy one for me to point at, where Canada's been very early in the launch of active ETFs over the years, particularly Mackenzie Investments. We launched our ETF platform in 2016, very quickly followed with active fixed income. And there was hardly any to be found in the Canadian market, ETF market at the time. So the Canadian ETF market has shown a lot of innovation, which has certainly also been quite attractive to advisors and investors.
I'm glad you point that out. Let's stay with that for a moment. It wasn't too many years ago that if you mentioned ETFs for most people in their minds, they initially or immediately thought of indexed exposure. That's certainly changed. Not only have we seen a proliferation of different active solutions, but we've certainly seen an enormous amount of capital flow into these solutions. Why is that? What explains the success of active ETFs?
Yeah, that's definitely a common sentiment, and it highlights just how far ETFs have come. And, I think it's important we start with the definition of active versus passive. It seems pretty basic, but I think let's start there for a moment, because how we see passive defined, or what a passive ETF is essentially something that's tracking a market cap index, right? Like it's your S&P 500 equivalent solution. Active is anything beyond that, right? And certainly anything that isn't index tracking, but in some cases you get into such specialized, custom, thematic indexes that I don't see them. Mackenzie doesn't really see that as passive per se. So I think it's important we first differentiate between what actually means active ETF versus passive or index ETF today. So we've seen a lot of product come to market over the past 5 years, close to 600 ETFs, in fact, that are characterized as active ETFs. So that has definitely helped in terms of attracting more investors, more advisors to the ETF market who are looking for something beyond just your basic market cap weighted ETF exposure. And that has led us to seeing more than half of the total number of ETFs here in Canada. So that 1,500 number that I shared earlier, 53% of that is now actively managed ETFs in total count. In assets, we're close to a third, right? That's substantial growth, which has primarily happened in the past 3 to 5 years. And so this is where you're seeing, like I say, a significant pickup of new investors, new advisors who see more options available to them in the ETF market, exposures they would have typically found in mutual funds only here in Canada, where they now have the ability to use the ETF vehicle if it so fits how they're constructing portfolios, or how they're intending to sort of even short-term or long-term trade or hold such mandates. So choice is, I keep saying it over and over again, the more options available to investors and advisors, the better it is for them to be able to build portfolios. And that's definitely helped in how we've seen even active ETFs grow here in Canada over the past 5 years.
Excellent. I want to turn back to the report now. Prerna, we speak on the heels of an announcement by Prime Minister Trudeau that he's stepping down as head of the Liberal Party. And I can't help but recall in the report that you called out 2025 as a year where there would be significant geopolitical uncertainty, not only in Canada, but globally. You also mentioned economic uncertainty. But what's the connection with ETFs? And maybe for our listeners, help us understand how it could lead potentially to more resilient portfolios.
Absolutely. And I'm going to point to some examples in the past, because as much as we say the past doesn't repeat itself, it so often does. And so I think it's helpful to look at some examples from the past as well here. And I'm going to separate my response into two parts. I'm going to talk first about the ETF vehicle itself and its attractiveness to investors in uncertain times. And then I'll speak to the types of strategies you can often find in ETFs, which can help investors and advisors navigate those uncertain times more effectively. So if we look at the vehicle first, ETFs have, as we know, two layers of liquidity, right? So you have the underlying liquidity in a portfolio, which is similar to mutual funds, right? It's the liquidity of the underlying securities, the bonds, the stocks that are held in there. But ETFs also have a second layer of liquidity, unlike mutual funds, and that is that secondary market trading on the exchange, right? Because ETFs are essentially bought and sold on the stock exchange. So there are two layers of liquidity, which can make a tremendous difference in periods of uncertainty when you are trying to buy, but more importantly, sell out of a position in a very short period of time where you might have a liquidity crunch. Now, I'm not necessarily calling for those types of markets in 2025, but this is where, as you see uncertainty start to build, you do tend to have more of a drive toward ETF usage in portfolios because you know that even if underlying markets may have trouble from a liquidity standpoint, you're going to have secondary market liquidity at your disposal. So we saw this in the global financial crisis. We saw this in the 2020 initial pandemic volatility. We've seen this through the Russia crisis. We have many, many examples in the past 2 decades to point to show that in even those extreme events of those one day, liquidity crunches, ETF investors have been able to get off their position if they so choose, and allocate elsewhere in the markets, take advantage of timely opportunities even in those environments. And so I think that vehicle specificity itself is going to potentially drive even more engagement in ETFs in 2025. Now, that's the vehicle conversation. Now, ETFs also are unique in some ways to mutual funds, for example, in Canada, where you can often find lots more building blocks on offer. What do I mean by that? It's not just about a balanced fund. You can find very specific sector strategies, for example. You can find niche strategies. You can find thematic exposures. You can, even in fixed income, go up and down the duration spectrum and really pick a spot to be at. So if you are managing your portfolios in a way that you want to have those levers at your disposal, you have more options often in the ETF market than you do in mutual funds, for example. And so we have seen more advisors, particularly those that construct their portfolios from a portfolio construction standpoint, act like more of an asset manager, asset allocator, look to ETFs for those building blocks. So, some examples of products I think are going to continue to be attractive to investors in the ETF market in 2025. I think low volatility ETFs are going to continue to be of interest to certain investors who want to be invested in the markets without having the same level of volatility as what the market presents at any given time. We're going to see continued interest in certain sector or thematic ETFs that really allow you to be very targeted in the exposure you're looking for. And we're going to continue to see investors look to bond ETFs. Like I said, whether they're being very specific and looking for certain duration, certain credit risk, or outsourcing that entire decision to an active manager, but doing it in a way that they have both the primary market liquidity and the secondary market liquidity that ETFs offer. So both, I think, the vehicle and the product choice are going to continue to be in favor of ETF growth here in Canada in 2025.
That's great. Now, you mentioned the vehicle. You spent a considerable amount of time walking through the liquidity advantages within the vehicle. I'd love to get your thoughts. How much of the growth in model portfolios by advisors in Canada, particularly those who are running discretionary books, we've seen a real uptick in usage of ETFs. Is liquidity the sole reason? And if not, what are some of the other reasons that we're really seeing this rise in usage?
Yeah, liquidity is an important feature, undoubtedly, because it presents flexibility, which is important as a model portfolio manager or asset allocator. The precision piece is also important, right? So having both on offer, large, more wholesome strategies, your sort of balanced fund equivalents in ETFs, but also, as I mentioned, finding the specific, very targeted exposure to get your precise tilts within a portfolio, that makes for easier model management. And so we've seen more advisors turn to ETFs for those reasons. In some cases, it's operational. There's definitely operational benefits at many dealers that advisors benefit from in using ETFs versus funds. So if you're making a change to your model, it's far easier to implement that often with ETFs. And whether you're dialing up exposure, dialing down exposure, adding new exposure, you can affect that across your entire client book in a much easier fashion. So there's definitely some operational benefits to using ETFs as well. For advisors, I think we're going to continue to see those leaned in on by advisors. Even if you look at two strategies, a fund and an ETF, equivalent strategies, we have some of those on our shelf here at Mackenzie. Just even the fee savings of your admin fees can make a difference for certain advisors, right? We continue to have many fee discussions. Our advisors continue to have many fee discussions with their clients, as do we with our advisors. And sometimes that admin fee savings alone can make a significant difference in that total outcome for clients. So, sometimes even looking at the ETF vehicle for such fee savings in identical mandates, fund and ETF, where obviously the admin fee doesn't necessarily apply in ETFs. It's a different type of vehicle that's managed differently, so you don't have the same admin costs. Can help advisors ultimately help clients. So that's another reason why advisors have also sought to look at the ETF market. And lastly, just having more on offer, whether it's specialized ETFs, ESG mandates, thematic mandates, more that they can use to, like I say, tilt and really express their views and be timely, right? So, if you have a view on the Chinese economy over the next 3 months, you can affect that very easily with ETFs, lots of options available, passive and active, and be able to move off that position very quickly if you so choose as well. You don't have hold periods in ETFs like you do sometimes in funds. So if it's not 3 months, it's 3 weeks. You can still be able to affect that with ETFs. So there's a lot of this flexibility and precision benefits that advisors really have witnessed, and are going to continue to, I think, look to the ETF market for in 2025.
Lots of options in the ETF world, Prerna. Are there specific or certain types of ETFs you're seeing right now, early in 2025, versus others as it comes to how advisors are utilizing this vehicle to run their model portfolios?
There's a certain level of core allocation that we're going to continue to see, right, from advisors that continue to allocate to markets. We saw this in 2024. We're going to continue to see this in 2025. And some of it is just core passive exposure, like U.S. large cap equity, where they're picking just the S&P 500 equivalent. But there is a lot more usage of ETFs in areas like yield generation. So as you have aging clients in your office, and you're looking for different ways to generate that income to meet their drawdown needs. We know fixed income is not the only place to look for that anymore. So how is the rest of the portfolio working for clients? And so there is more interest, certainly, that has built up over the past couple of years. I see that continuing into 2025. Where there's going to be a need for income from different sources. And that doesn't mean free of risk, right? Because we are all living for longer periods of time, which means we still need some level of appreciation. We're not in sole drawdown mode. And so having creative ways to get to that is important. So, we're continuing to see more interest in those mandates. And then I'll say active fixed income. It is the largest portion of the active ETF space here in Canada. If you sort of strip out the asset allocation ETFs, which is a different category, different product type in itself, but active fixed income ETFs continue to be very attractive to investors because it is so difficult to navigate fixed income on your own. Even the most sophisticated asset allocators in Canada can often find themselves in periods of time where it's hard to know how to navigate fixed income markets. And so it becomes really helpful to be able to outsource some of that or all of that decision on the fixed income side to experts who do this all day long. And so, we've seen this evolve since 2017, very early on, with many products on our shelf. Floating rate loans is a great example where we built that category from nothing here in the ETF market, and now are the dominant product available in the Canadian space. But there continues to be a look to active fixed income managers and ETFs to help navigate what will continue to be a very complex fixed income environment in 2025.
Very helpful. I'd like to stay in fixed income for just a moment. And in Canada, we have a central bank that's aggressively cutting rates. At the same time, south of the border, it's unclear how much more the Federal Reserve necessarily wants or needs to keep cutting rates, given strong growth, hot inflation. You've already talked about geopolitical risks. Kind of mind-numbing. There's a lot going on from a macro perspective. So when you think about fixed income solutions, what do you think right now are some of the timely solutions advisors and their clients should keep top of mind?
That complexity is often what drives the conversation to our unconstrained bond ETF. And it is, as we describe it, the go anywhere strategy. Our portfolio managers have the ability to navigate across duration, across credit risk, and across geographies. And so it becomes and has proven to be over the years an effective place, an effective product for client portfolios to really, like I say, outsource that decision and let us think about it where we're analyzing those markets all day long, every day. So that's a product we continue to have lots of discussions with advisors about. If, as an asset allocator, you are looking for more building blocks, we have many solutions on offer that allow you that higher quality tilt, which is where we're spending a lot of time talking about, right? Is higher credit quality. And so something like our US investment grade bond ETF, QUIG, is one that a lot of asset allocators look to as just US investment grade, high quality exposure, as again, that sort of building block for an asset allocator. Tips. It's interesting. We've, been very hot on tips in certain times over the past few years. We still have a very constructive long-term view on tips. We still see that as a solution even in the short term that could be quite attractive to investors for some inflation protection, particularly in the U.S. market. So those are some of the products on the building block front that we talk about, but certainly MUB being that core, outsourced. Let us make the tough decisions on where to go as a geography, duration, and credit risk perspective.
That's great, Prerna. Now, you spend a lot of time speaking with advisors, and I'm just curious because many advisors, most advisors, in fact, are very familiar with ETFs, a growing number want to use them, but perhaps their clients aren't as familiar with the ETFs. From your experience and perspective, what does that conversation look like between an advisor and a client when they want to use this vehicle?
It's very much education and demystification, right? There's still a lot of myths amongst Canadian investors about what ETFs are. And as we know, headlines don't help, right? Whatever makes it into the media, usually the noise, is the 5%, not the 95% that's happening in the markets. And so, it could be that over the years they've seen headlines in the US, for example, and a lot of it is US centric media exposure on ETFs, where you've seen ETFs go bust or something like that. So sometimes it's these myths that exist in investors' minds, or sometimes it's just lack of education and awareness. And so, we spend a lot of our time providing advisors with the tools needed for them to have that conversation in terms of educating their clients about what ETFs are. And starting from essentially the point of these are very similar to mutual funds, right? So, if you've been familiar and have had invested in mutual funds over the years, over the decades, let's start with how ETFs are similar to mutual funds. And then we can talk about how ETFs are different. And in many ways where the benefits actually lie with ETFs versus mutual funds and how they can help in a client's portfolio. So that's typically where we start is, let's actually compare them to mutual funds and how similar they actually are, and then where the differences lie. And then let's talk about some examples. What does that mean in terms of what an ETF actually is and what it holds? And so, I think even in 2025, we're going to continue to have this discussion. Like I said, the user pie is growing, right? Every year we're seeing new investors and new advisors adopting ETFs. And so I remember having these conversations with advisors, investors a decade ago, and I'm having the same conversations today with newer advisors or advisors with new investors to ETFs. So I think it's incumbent on the entire ETF industry. We take it quite seriously here at Mackenzie. We spend a lot of time with our advisors, ensuring that they feel comfortable in being able to educate their investors. So I definitely it's an education piece, and I think we're going to be collectively spending a lot of time on it in 2025.
My final question, given that we've been talking about clients and how clients interact with advisors, and we've talked about the vehicle and specific types of solutions, is income. On the subject of income, I know that's a problem that is top of mind for many, if not all, clients, and as a result, many, if not all, advisors. Now, we talked a little bit about fixed income before, so I just want to come back to this topic, but a little bit more specific from a client's perspective. How do you solve for that income problem if you're using the ETF vehicle?
There are a spectrum of solutions now available in ETFs, depending on the risk you're wanting to take in the portfolio, right? So this is where it becomes very important as the advisor looks at the entire client's portfolio, their ability or willingness to take on risk versus the income that needs to be generated. You can start from some very safer, I'll call it, alternatives, like your ultra short or cash offerings in ETFs, straight through to covered call, light levered ETFs that give you equity like exposure, but produce a fairly high yield, right? So it becomes incumbent on the advisor with this much choice to really put into context from a portfolio construction perspective, what is that level of risk that the client is willing to take versus the income that they're looking to generate? And how do these different solutions potentially fit in that client's portfolio, right? Because you can have a disconnect, right? Sometimes you see a very attractive yield, for example, in a covered call ETF, and the client is unaware of what that actually means from a total return perspective in some of these mandates. That income is being generated off of the return over the long term, right? You're getting that income today off of the trade-off in the long term. And so as long as you're making these decisions in a manner that fits within that portfolio framework for the client and that the client really understands how that income is being generated, the choice is wide, right? So and like I said, it's not just about the options and fixed income anymore. In equity, you can start with the very vanilla dividend funds, dividend ETFs that offer you just the dividends clipped from the underlying securities held in the portfolio. And then from there, you can get into some, very niche and more risky products in the ETF space. So like I said, covered call ETFs are a very big category, and now levered ETFs on those covered call offerings as well. There are even single stock ETFs with covered call with lever. And so you can see it can get quite risky if the correct due diligence is not paid. So the conversation that we often have with advisors as they're trying to solve this income challenge for their clients is in understanding that level of risk, is in understanding what else is in the portfolio generating income, and so what is that gap, right? And so and then determining how best to fill that. So I think it's going to continue to be in focus in 2025 and beyond. Like I said, with an aging population, undoubtedly income and the need for income is not going anywhere, and you will continue to see, I think, innovative solutions in the Canadian market, including hopefully from Mackenzie in the near future to help continue to address those challenges that investors are going to face.
That's really great perspective, Prerna. We opened talking about the growth that we've seen in the ETF space, but what's very clear from our conversation is that the pace of innovation in the ETF space is not slowing down. And in fact, as we get into 2025, is clearly moving at a blistering pace. And the vehicle seems to be pretty well positioned to continue to solve problems for advisors and their clients in the years ahead. Prerna, I think I'm going to wrap up our conversation there. I wanted to thank you for joining the podcast, and I look forward to speaking with you in the future on some new topics related to ETFs.
Thank you for having me, Rajan.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.